We are on the first lecture on understanding cross-border trade. We have 10 sections, and each section will have 4 to 5 episodes, and we will understand cross-border trade. In this section, we talk about financial risks. Let us try to understand cross-border trade, the risks associated with it. There are complexities while we are operating across national boundaries because there are differences in the economic, political, and market dynamics. These bring in certain uncertainties. The risks threaten the profitability, liquidity, and long-term viability of the international business if you don't have robust risk management framework. In a domestic trade, compared to cross-border trade, the risks are less because in an international interaction, you have multiple currencies, multiple legal systems, differences in the economic environment, and these variations amplify the exposure to volatility. For example, if an exporter from Brazil is selling to somebody in Europe, he not only faces a normal simple liquidity risk of default by the buyer, but also the sudden devaluation of the home currency against the invoiced currency, that is euro. Let us look each of these in detail in the subsequent slides. Currency fluctuation and exchange rate volatility is the first subsection. Exchange rates are cornerstone of international trade because they dictate the cost of goods or services, the capital flow between the countries, and the cost of goods sold. They are influenced by dynamic interplay of economic indicators, policy decisions, and global events, sometimes real, sometimes speculative, and they are inherently volatile. What is an exchange rate? It is how much of one currency can be exchanged for another. For example, 1 US dollar can be, say, 0.85 euro. Exchange rates fluctuate based on market-driven supply and demand in the normal course, but they are also affected by central bank interventions and fixed policy changes or policy regimes. There are also risks like non-payment risk or the insolvency risk of the buyer if they default to settle, maybe because of fraud, maybe intentionally, or maybe because of the political barriers. There is also a risk of economic instability, which is beyond the buyer corporate. It could be because of the economy or the country or the political influences. They cause inflation and other uncertainties which erode the value. Now, what are the different types of exchange rate systems? Floating rate system. It is determined by the forex market dynamics. The foreign exchange market dynamics is demand and supply. For example, dollar versus euro, euro versus yen. So the rate reflects real-time trader sentiment and economic data. Then there is a fixed exchange rate. That is, the currency equivalent is pegged to a stable currency or an asset. For example, Saudi Riyal is pegged to US dollar at 3.75 is to 1. Qatari Riyal is pegged at 3.65 for every $1. So this ensures predictability, but it requires substantial reserves to be maintained. Each of the Middle Eastern currency are pegged to US dollar at different rates. Managed float. It is a hybrid where the central bank intervenes to stabilize the currency within the range. For example, Chinese yuan, which is managed against a basket of currencies to balance the trade competitiveness and stability. What are the key factors that influence the exchange rate? The most important factor is the interest rate. Higher the interest rate, they will attract foreign investment, boosting the currency demand. For example, US Federal Reserve, if they raise the rates in 22, the US dollar will strengthen against the euro and funds from institutional investors will flow into United States. So the exchange rate, dollar will strengthen. Inflation rate. If there is a persistent inflation rate causing erosion in the currency's value, then the currency will come down. For example, in 2023, Turkey's high inflation rate, almost 50-60%, led to a sharp decline in the Turkish lira against dollar and euro. Then comes the political stability. Political crisis will trigger capital outflows. It will weaken the currency. This is what happened in 2024 in Bangladesh or Sri Lanka in 2023, etc. For example, in 2014, the Russian ruble plunged a lot because of the threat of sanctions and falling oil prices. And because of this, ruble lost around 40% of the value within 1 year. Then comes the trade balances. Persistent trade deficit, that is, if the import is more than export. If you are having less import and more export, then you will have a trade deficit. For example, what is United States having today? The pressure on the currency will be downward. The US trade deficit with China historically weakens the dollar relative to the Chinese yuan on certain periods. Let us look at what is the impact of this volatility in the exchange rate. Exchange rate volatility creates uncertainty as to how much you will have to pay for your purchases or how much you will realize against your sales. That is, it will disrupt your costing and pricing. It will disrupt your competitiveness. So, first is the transaction risk. The risk that the exchange rate changes between the time the deal is agreed and when the payment is actually settled. For example, you have a Canadian exporter who sells machinery to a German buyer at euro 500,000. Payment is due in 6 months. So on the date of contract, one Canadian dollar could be 0.68 euro. But on the date of realization, it could be not 0.68 but 0.60. So what will happen? Your revenue will form by about 100,000 Canadian dollars for this 0.08 change in the exchange rate. So during 2015, the Swiss franc was unpegged from the euro. The exporters in Switzerland faced the sudden losses because Swiss franc surged 30% overnight, inflating the foreign invoices. So this is a transaction risk. Looking at translation risk, it is a risk that the currency fluctuation affect the reported financials of the multinational companies when you have a cross-border transaction and a multi-currency balance sheet. So if you have foreign subsidiaries and they have their funds in different currencies, and if you are consolidating them at the head office level, then take a case of a US company with a UK subsidiary. The UK subsidiary reports 10 million in profit, and the exchange rate considers $1 equals to 0.80 Great British pound. This is 12.5 million in US dollar terms. But if the GBP weakens and it becomes 0.90 GBP per dollar, then the same 10 million transfers to only $11.11 million and not $12.5 million. This reduced the reported earnings in US dollar is to the tune of 1.3 million. So in the US balance sheet, the profit will be lesser, though the UK subsidiary made the same amount of profit, that is GBP 10 million. This is a translation risk that happens on the book value or a market value conversion. For example, in 2022, Apple reported lower earnings, mainly because stronger dollar reduced the value of the overseas revenues. Right? Then we will look at economic risk. The long-term risk that sustained currency shift after a company's market position or competitiveness getting altered. Weaker Indian rupee boosts Indian exports. So for example, if you have a textile exporter, they will make their goods cheaper abroad but raise the cost of Indian importer of raw material like a cotton. Conversely, a stronger INR could price the exporters out of the competitive markets. In real world, what happened is that in 2010, the Japanese yen depreciation due to Abenomics, Abe was the prime minister then, enhanced the Toyota's global pricing power. At the same time, it squeezed a smaller number of smaller importers who are reliant on the USD denominated inputs. So this is the impact of the exchange rate fluctuations. Also, let us look at how it spreads at the country level. The Asian financial crisis. In 97-98, Thailand decided to float the Thai baht (BAHT) after depleting the reserves, and this led to 50% devaluation, sparking panic across the Southeast Asia. So ASEAN countries, Association of Southeast Asian Nations, all of them had a trigger effect or a cascading effect or a domino effect of this crisis. The currencies like Indonesian rupiah collapsed by 80%. The Malaysian ringgit and South Korean won lost a significant value. Businesses were facing skyrocketing import costs, and were having a problem of inability to pay foreign debt. This was the impact of the Asian crisis. What is the consequence? South Korea's Daewoo collapsed under the USD denominated debt, while the exporters temporarily gained competitiveness but struggled with the regional demand collapse. The lessons learned is that over-reliance on short-term foreign borrowings and weak financial oversight will amplify the crisis. Let us look at the impact of Brexit in 2016 to 2020 period. UK's 2016 referendum to leave the EU caused pound sterling to plummet from 1.5 to 1.2 against dollar overnight. UK importers faced a higher cost for the goods like oil and electronics, while exporters like Jaguar and Land Rover saw short-term gains in competitiveness. Inflation rose to 3% in 2017. So this, what happens is if the inflation goes up, the consumer spending will come down. The consequence is that retailers like Tesco had to raise their prices because of the higher import price. Exporters struggled with supply chain disruption due to uncertainty. And what is the lessons learned? The political uncertainty, which is a root cause for the Brexit, can trigger prolonged volatility, requiring diversified market to mitigate risk. Then comes the Turkish lira crisis. For example, in 2018 onwards, there had been a high inflation in Turkey. There is a political interference in the monetary policy. There had been US sanctions also. And this led to lira losing over 60% over dollar since 2018. Turkish importers are facing unaffordable cost, while exporters are gaining a lot temporarily, though they are constrained by instability. The consequence is that local firms default in dollar-denominated loans. Foreign suppliers demand upfront payment because of the currency volatility. And what is the lessons learned? Currency crisis often stems from structural weakness. It underscores the need for hedging at the corporate level and the need for diversified trade partners so that currencies can cushion off against each other. Let us look at the mitigation strategies available for this risk. The main thing is the hedging instrument. For example, forward contract. Agreement to exchange currencies at a fixed rate on a future date is a forward contract. To exchange one currency against the other at a fixed rate on a future date. What are options? They are the right but not the obligation to exchange a currency at a fixed rate. They offer flexibility. Forward contract is an agreement to deliver, while option is a optional contract where the exists. Does not exist, but the right exists to exchange a currency at a fixed rate. What is currency swap? Exchanging principal and interest payment in different currencies. UK firm swaps GBP debt for a dollar match. US revenue streams reducing exposure. So if your debt is in GBP, but if you are having a revenue in dollar, you can go for a currency swap between dollar and GBP. What's the cost of this? The forwards are binding and may miss favorable rate exchange, while options involve higher premiums but offer flexibility. The natural hedging happens if you are buying or selling at different currencies and they are able to match against each other. What's an operational strategy? The operational strategy is that you should be able to price in stable currencies, invoice in dollar or euro instead of going for each of the regional currency. So you can reduce the volatility. A Singaporean exporter, instead of Sing dollar, if you are able to do it in euro or euro, it will help to avoid fluctuation in realizations. Then diversifying the supplier or the customer base. If your counterparties are spread across different regions and different currencies, then it will be having lesser impact. The currency rate fluctuation will be having a lesser impact. If you are able to produce locally, then you don't have a problem of foreign exchange. That is, if you are able to establish a facility in the target market. For example, Volkswagen plant in China is mitigating the euro Chinese yuan risk by manufacturing in China itself. While natural hedging refers to matching the revenue and cost. You buy and sell on the same currency. A Canadian retailer with a US store uses US dollar sale to pay US suppliers. So whatever you are recovering in US dollar from your sales will be used to pay your suppliers. Then there is a balance sheet hedging. So you will offset the foreign asset with the liabilities in the same currency. If you are a Japanese firm with euro assets, then you will have to issue euro bond. So you will have an euro asset and you will have a euro debt. It will match against each other. So this will reduce the reliance on costly financial instruments to mitigate the risk. The next important aspect of the financial risk is the non-payment and credit risk. Credit risk arises when foreign buyer fails to pay due to the financial distress or fraud or external barriers or situations where it is threatening the exporter's cash flow and profitability. So the profitability will take a blow when you have a credit risk or even a non-payment risk. The profitability, the probability that the counterparty or the party from whom you are expecting money will not be pay you is higher when it is cross-border because of the complexities in legal systems and scope for instability. One of the reasons for non-payment is buyer insolvency. The economic downturn or poor management will lead to bankruptcy. For example, Lehman Brothers collapsed. Then comes a political risk. Sanctions, currency control, conflicts, they block the payments. For example, the Russian sanctions restricted flow of dollar payment from Russia, and that is a big problem for the people who exported to Russia. Then comes the discrepancies in the documents, errors in the documents required for payment. For example, if the bill of lading is not compliant with the letter of credit, or there is no letter of credit, but the bill of lading itself is not adequate enough to get it cleared in the customs, this will cause delay or denial of the payments. Then comes the fraud, a deliberate non-payment or misrepresentation of the credit worthiness. So these are some of the risks that are falling under the non-payment risk or a liquidity risk. If we try to look at how these convert into natural real um, situations, Argentinian economic crisis we can look at. In Argentina in 2001, the country defaulted on a 132 billion in debt and bank accounts were frozen. That is called a corralito because or it caused devaluation of the peso by 75%. Peso went down by 75%. The foreign suppliers from US lost over 100 billion in receivables. Exporters like the agricultural firms stopped shipping further to Argentina. The lesson is that political and economic stability can cascade. Then comes the Chinese corporate default. Evergrande, China's property giant, defaulted on a 300 billion debt. Global suppliers of steel, cement, and machinery faced non-payment in billions. Smaller Chinese firms also defaulted because of the cascading effect. Australian iron ore exporters and German equipment manufacturers scaled back their exposure by reducing exports to China. The lesson is that over-reliance on high-risk market or a high-risk buyer will amplify your risk. So you have to diversify. Another example is a Venezuelan debt crisis. 2007 onwards it is happening where the currency control and hyperinflation is preventing firms from accessing dollar. Foreign airlines, oil suppliers lost billions in trapped receivables. State oil company also defaulted on the debts. Companies like ExxonMobil had to exit Venezuela. They have to try to get prepayment sometimes, but others are not able to get any payment. The lesson is that sovereign risk require preemptive safeguards like escrow arrangement. What are the mitigative strategies for this? The most important mitigative strategy for financial risk is the trade finance instrument. Most importantly, letter of credit or a bank guarantee, where payment is against presentation of compliant documents. The risk is shifted to the bank from the corporate. Vietnamese exporter can use LC to get payment from a Nigerian buyer, for example. Export credit insurance can be adopted. The losses will be covered for non-payment due to commercial or political reasons. For example, Euler Homes or Coffees can insure up to 90% of the invoice value. A French wine exporter, if they insure their shipment, whatever happens in Brazil, the credit insurance will pay the exporter. In case there is a loss due to bankruptcy of the people down the supply chain at the distributor level. We can also adopt factoring, where we sell the receivables to a third party for immediate cash and transform the default risk into cash. Turkish textile firm will sell to European Union, and these invoices will be immediately factored and funds realized. Thereafter, the collection risk is transferred to the factoring agency. This is one way of controlling the default risk or a mitigation strategy. Another is due diligence. When we say due diligence, we look for the financial health. We check reports like Dun and Bradstreet or S&P to assess the buyer's bank, etc., so that whether we can rely on them or not, their credit rating and credit standing can be understood before the transaction is entered into. Second is escrow. A neutral party hold the fund until goods are delivered, ensuring mutual trust. For example, Indian software firm are using escrow services for US clients for milestone payments. Third is trade reference. Contact prior suppliers to confirm payment reliability. German machinery firm checks on Indonesian buyer history to avoid fraud or delay. Then comes the legal safeguard. For example, retention of title clauses. Ownership remains with the seller until full payment, enabling repossession in case of a default. Then comes the arbitration clause. Specify neutral dispute resolution to avoid cost in overseas courts or unknown territories and jurisdictions. Then guarantee. Require a parent company or a bank to guarantee for high risk buyers. These are the various aspects. What is inflation and economic stability coming into the picture? Now, talking about inflation, hyperinflation causes a lot of problem because they are defined as more than 50% inflation per month. It will cause what? Devastation to the economy, not only trade and commerce, because it will erode the value of the currency. So rapid uncontrollable price increase that renders the money nearly worthless is what we call as a hyperinflation. It is caused by excessive money printing or supply shocks. It could be demand pull, excessive demand overwhelming the supply, or cost push, rising input cost driving the prices up. Or it could be monetary expansion, printing of the money by the government without having enough reserves or to cover the deficit. Historically, Zimbabwe had been facing the problem of 80+% inflation, and because of that, Zimbabwean currency has become almost obsolete, forcing trade in dollar or barter system. The consequence is that the South African food exporters demand payment in dollar while local firms have collapsed. Then we have the Venezuelan example where the inflation had hit 2% by 2 million% by 2018, with Bolivia losing Bolivar. Bolivar is the currency of Venezuela. It lost almost 90% of its value. Importers could not access dollar due to controls, and exporters struggled with collapsing demand. So barter trade is going into it. Business consequences is that the multinationals like General Motors had to exit the country. Then comes the Weimar Germany example, where there is a 30% monthly inflation and wheelbarrows of cash are needed for bread. wheelbarrows of cash are needed for buying bread. Export competitiveness collapsed, costs soared, import became unaffordable. So the business consequence is that German firms defaulted on foreign contracts. So that is one form of hyperinflation. Then comes a stagflation, that is high inflation with stagnant economic growth and unemployment. Unemployment, stagnant growth, and high inflation. This will create more challenging trade environment. Example, the 1970 oil crisis is a good example where OPEC in 1973 caused an oil embargo, quadrupled the prices and drove US inflation to 13% in 1980, while the gross domestic product contracted. So the importers will face a soaring energy cost, exporters will struggle with the weak global demand. This is what will be the impact. The consequence is that trade will slow down, inflation will erode the profit, currency will be volatile. So the Britain would also added to the complexity on this 1970 oil crisis. Today, in 2020, for example, supply chain disruption and energy price spikes can be seen, causing stagflation, stagnancy plus inflation, which also is due to the sluggish growth in the eurozone. What are the mitigation strategy for the inflation risk? One is price adjustment. By price adjustment, what we do is the indexation clause in our contract, linking the price to the consumer price index of the country. For example, Chilean copper exporter will index the USD contract to US cost of price, US consumer price index. Likewise, dynamic pricing. Adjust the prices frequently based on cost. German chemical firm raises the EU prices quarterly to reflect the energy inflation. Then comes the prepayment term. Prepayment is advance payment that it will take some portion or a large portion. Local currency hedging is inflation-linked bonds, where you will invest in security which are linked to inflation. So if the prices goes up, inflation goes up, the returns on the bond may also go up. Then comes the commodity hedging. Use a futures contract to lock in the cost of highly used commodities. It could be electricity or it could be aluminum. Then comes the local financing. Borrow in local currency, purchase in local currency. So localizing the currency. Then comes the diversification, market diversification. That is expand to stable economies, then multiple economies, product diversification, offer varied goods which has different margins and different requirements in different seasons so that there is no sector specific or period specific risk. A Thai agribusiness company will sell rice and seafood to balance the commodity price swings. When the rice price goes up, the seafood price might be coming down. So it will get adjusted. Then comes a supply chain redundancy, sources from multiple countries to avoid regional shock. For example, China plus one strategy. So to summarize, financial risk in cross-border trade are in multiple forms: currency volatility, non-payment, inflation, etc. They pose significant challenges. The fluctuations demand hedging tools like forwards or options. The non-payment risk require rigorous due diligence or trade finance instruments for risk mitigation. The inflation and instability call for flexible pricing or diversification or local currency targets. So by integrating these approaches, businesses can navigate global uncertainties and safeguard profits. Staying informed about the macroeconomic trend and leveraging technology for real-time risk monitoring will further enhance the resilience in the dynamic landscape of cross-border trade. Let us meet in session 2. Till then, goodbye.